Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years, been a CPA for about that long, and I've got great ways to explain accounting, so you're at the right place to learn accounting. This lesson is designed for people that are in their third, fourth, fifth week of accounting class, their very first accounting class, and this is usually chapter 3 of your textbook. So, it's probably a good review for people that are in intermediate 1 too. Adjusting entries are not easy. They are difficult. Everybody struggles with them. If you're struggling with them, you're a normal person, and being normal is a good thing. So here we go. Hey, by the way, I've got a brand new website. It's called accountingsuperstars.com. It's got all these videos listed out so you can find them by topic. So check it out. So in case you'd like to see more of this. So here we go. We've got Fred's snowblower service. And on the left-hand side of the screen, we've got a trial balance. And this trial balance, it's simply all the accounts added up, their balances, and the accounts are listed out, whether it's a debit or a credit. It all balances out. In fact, it balances out to a perfect $1,000. Now, what I did is I went ahead and made an income statement without doing any adjusting entries at all. And the reason why I did this is I just want to compare the income statement that has not been adjusted with an income statement that is adjusted, just to show you that it can make a world of difference here. So here's an income statement right here on the right hand side of the screen, and all I did was take the items off of this trial balance that belong on an income statement. So what two things belong on an income statement? If you've been watching this video, you would know this: revenues and expenses. That is it. Nothing else. No cash, no receivables, no inventory, no liabilities, just revenues and expenses. That is it. All right. So here's what we got going on. We got repair revenue, $400. I got that right off the trial balance. And here are all the expenses. Got this right off the trial balance. And cost of goods sold is an expense too, even though it doesn't say expense. It's an expense. And it looks like Fred's doing pretty well. He's making a profit here of $120, and I kept the numbers really small so that way we could focus on the concepts and not worry about the numbers so much. So this income statement, though, does not include any adjustments, so it's not really very accurate. And in this case, you'll see that Fred's business is doing quite different than what is shown here in the unadjusted income statement. And by the way, I don't know of anyone who would do an unadjusted income statement. That it really doesn't make any sense to do that, except to make a comparison. All right, so here are some adjusting entries. We've got 5 adjusting entries, and I'm going to split the screen just to make it easier to see what is going on. All right, so view, split. All right, and I'm going to come down here to where the general journal is. Okay, so here are the adjusting journal entries. So let's see what's going on with the first entry. Adjusting entry number 1. Fred did more work than is reflected in the unadjusted trial balance. Fred completed $20 of work at the end of October, but did not have time to send a bill to the customer. Accounts receivable. Since Fred did not send a bill to the customer, the completed work was not recorded in the accounting records. Regardless, the revenue was earned in October and should be included in October. I also have a hint here, debit accounts receivable. So here's what's going on. Fred did some work for a customer, $20 worth of work, and didn't get paid, and so it didn't get entered into the accounting records. Fred's on more or less a cash basis, but we know from our accounting class so far that we try to do our accounting on an accrual basis. That is, we recognize revenue when the revenue is earned, when we earn it. All right, so to make that happen, we're going to do this adjusting entry right here, and I'll explain what it is. So what we're going to do is we're going to debit accounts receivable, which is an asset, for $20. Now we're debiting accounts receivable because this customer owes the money. Fred did the work and the customer owes the money. And we're crediting revenue to reflect that the work was completed. We only record revenue when work is completed here. All right, so here we go. Here's adjusting entry number 2. According to the unadjusted trial balance, Fred should have $150 worth of parts inventory. However, Fred took inventory of his parts and estimates that the amount of parts sitting on the shelf is really $60. So his account says $150, but he really only has $60 of parts inventory. Fred used the parts to complete repair work. Now I've got a little hint here. The hint says 150 minus 60 is 90. So this will come into play. So let me show you where this is all coming from. So going back up to our trial balance. Here we go. Here's our trial balance. So here's this parts inventory, folks, right here. I'm going to highlight it just so it stands out just a little bit. There we go. So parts inventory, the account says $150, but Fred counted the inventory and said, hey, I don't have $150 worth of parts. I only have 60. So he used up the parts. He used up $90 because 150 minus 60 is 90. So he used up 90, he's got 60 left sitting on the shelf. So let's go down to our adjusting entries. And this is what it would look like. Okay, so Fred would debit parts expense for $90. Now, expenses are usually always listed first. I mean, usually, sometimes they're listed second, but like 99% of the time you list them first. So parts expense, $90 listed first. Parts inventory, we're crediting parts inventory to decrease the parts inventory, to drop it down by $90. So let's go down to the third adjusting entry. Now, Fred has never depreciated his equipment because Fred was not sure what depreciation was. However, Fred has determined that he should depreciate his equipment by $25 for the month of October. And here's another hint, expenses are usually listed first. Now, I don't know if you remember that video that I did on depreciation expense, but here's the journal entry to record depreciation expense. Now, expenses, 99 times out of 100 are listed first. So we have depreciation expense for 25 and accumulated depreciation for 25. That depreciation expense is going to go on the income statement. What goes on the income statement? Revenues and expenses. And accumulated depreciation is going to go on the balance sheet. All right. So if you're confused by this entry, watch those videos on depreciation. And you can find them if you go to accountingsuperstars.com. There, you can find those videos that I did. They're listed by topic. Let's go down to entry number 4. Number 4, a customer paid Fred $50 in advance to repair a large snowblower. Fred knows to never claim revenue unless Fred has completed the work. And good for Fred. Fred is exactly right. You never, ever claim revenue until you have earned it, until you've done your job. And Fred hasn't done his job yet. So let's go up and look at the accounts just to see if that $50 is up there in those accounts. So there it is. I'll highlight it here in pink here. All right. So unearned revenue is sitting there at $50 as a credit. It's a liability. All right. It's listed right after accounts payable in this case. So what this means is that $50 means that Fred owes his customer some work. It's a liability. It's an obligation. So let's go down and see what's going on here. I'm sorry, we got it right up here. So now, Fred believes that he earned $30 of the $50. So Fred should claim revenue and reduce unearned revenue for the $30 of work completed. And I've got a hint. List revenue second when recognizing revenue. So here's a good rule of thumb to help you out. Whenever you have an expense, list it first. Whenever you have a revenue, list revenue second. And that'll help you with these journal entries. So this $50, Fred is saying, hey, wait, I've done some of that work. I've done $30 of that work, and I should claim that $30 as revenue. I don't want to overstate how much I owe these customers. So here we go to the 4th entry. So there we are. So unearned revenue is being debited for 30. That will reduce the unearned revenue. Revenue is being claimed or recognized by 30 because Fred has done the work. So coming down to the last entry. So as of the end of October, Fred's workers have worked hard and have earned $70 but have not been paid. The $70 represents an expense for the month of October and should be included in the month of October. All right, so we've got an expense happening. So guys and gals, we're going to list expenses first. Now, let's see here. Rather than using the accounts payable, usually reserved for inventory suppliers, Fred is going to create a new account called wages payable. Now, wages payable is a liability. Whenever you hear that word payable, it means liability. It's a bill. If we list expenses first, it would look like this: wages expense 70, wages payable. So what this means is the workers have earned their money. We've consumed some resources here, and $70 is owed. No, the cash has not been paid out yet. So coming down here to the next part here, I've got a big giant spreadsheet here. Now these spreadsheets, we don't teach this much in accounting anymore. It's kind of old-fashioned, but I like it. I think it helps people understand what's going on. So what we're going to do is take those entries that we had up above, and we're simply going to put them onto this spreadsheet. So here's what's happening. This unadjusted trial balance, here the $50 and the $30 and the $150, where did that come from? That came from the original trial balance. So this original trial balance up here, all I did was take these numbers and I took them and set them down here in this big giant spreadsheet. That's all I did. Copied them. That's it. No math was done, just copying. All right, so copy these numbers down here. And so what we're going to do is take these adjusting entries, like this first one, and put them in their appropriate places. And to help out a little bit, I highlighted them in dark green here so you know where they're going to go. So the first one here is accounts receivable, a debit for 20. So let's put it here as a debit for 20. And revenue, we have a credit for 20. So let's go down and find revenue. Put it here as a credit for 20. Now, the way this worksheet works out here today is that revenue is going to need another entry here. That's why I left a little bit of a space, and that's why you see this kind of a box outlined here. All right, so coming down to the next entry, parts expense 90 and parts inventory credited for 90. So let's take them one at a time. Let's go down here to parts expense. And I've got parts expense highlighted in a darker salmon color. The reason why is I added that account, and it's okay to add accounts. If you need an account, just add it to your list here. So parts expense 90, let's put 90 right in that spot. There you go. And parts inventory is being credited for $90. So you just put that right up here. Parts inventory, credit for 90. So really no math is going on. All we're doing is copying numbers. And of course, nowadays computers do this really well. Depreciation expense is being debited for 25. Here we go. Let's find depreciation expense. And I have depreciation expense highlighted in a dark salmon color. Because I had to add that account. It's okay to add accounts. Nothing wrong with that. So take this 25 and let's drop it right down into place. There we go. Accumulated depreciation. I had to add that account also. Here we go. Accumulated depreciation, and I put it right under equipment here. And I've got it highlighted in this dark salmon color because I had to add it. You know, whenever you have to add an account, just add it. No big deal. So this $25 credit is going to go right into that spot right there. So we're on transaction number 4 now. So unearned revenue is being debited for 30. So here's unearned revenue right there. Debit it for 30. And we've got revenue being credited for 30. And so it's going to go right here. Here's revenue, and that's the second entry. So I've got revenue here taking up these 2 spaces, just so it's easier to understand. So wages expense is being debited for 70. So here's wages expense debited for 70. And wages payable being credited for 70. So let's find wages payable. And I added wages payable. There it is, wages payable, $70. Had to add that account. All right, so I'm going to get rid of this split so we can see a little easier here. Here we go, and come down and look at this spreadsheet in its entirety. All right, so all we're going to do now is figure out this adjusted trial balance, and it's really easy. Here's how we do it. I'll just do 5 or 6 of them, and you'll get the hang of it here. So let's start with cash. So cash has a debit balance here in the unadjusted trial balance of $50. There are no adjustments, so let's carry it across here, and it'll have a debit balance of $50. All right, and all we're doing is carrying it across here. Accounts receivable has got a debited balance of 30. In the adjustments, we're adding another debit, so that is a grand total of 50. In other words, add a debit with another debit, you get a bigger debit. There you go. Now, parts inventory. Parts inventory starts out as a debit of 150, and we're crediting it for 90. So 150 minus 90 is 60. There you go. It makes sense. If you recall, that parts inventory, Fred really only had $60 of inventory sitting on the shelf. Merchandise inventory, it's a debit for 200. There are no adjustments, so we will put it over here at 200. Equipment, 250, debit, no adjustments. Put it right there. Accumulated depreciation. Now there's nothing in the unadjusted trial balance, but we are crediting it for 25. So the adjusted trial balance will be 25. There you go. Nothing plus 25 is 25. Let's just do a couple more. Accounts payable starts out being a credit for 130, no adjustments, so we'll have a credit of 130. Wages payable, nothing in the unadjusted trial balance. However, we're crediting it for 70, so we will have a credit of 70. I hope you're seeing the pattern here. And folks, it just goes on and on and on down here. Let's go down here to revenue. Now, revenue has a credit balance of 400, and then we're crediting it for 20 and another 30. So 400 plus 20 plus 30 is going to be a credit for 450. There you go. So that's all we need. And let's just finish this out here. Here's the expenses. Let's just add them up here. And an important step here is to add up the columns. So there you go. So we got our columns added up. Alrighty. So what we're going to do is we're going to use the information from the adjusted trial balance. We can actually forget about the unadjusted trial balance. We can forget about the adjustments. But now that we have the adjusted trial balance, let's work with those numbers and continue on. We're almost done here. So what we're going to do is we're going to make another income statement. And if you recall, at the beginning of this lesson, we made an income statement right up here, but it was unadjusted. It was without all these adjusting entries. And this income statement showed a net income of $120. So it looked like Fred is doing pretty good. So let's see if Fred really is doing that good. You see, these adjusting entries make the income statement more accurate. So here's all we're going to do is we're going to take numbers off of this adjusted trial balance right here, and we're going to put them right here. So I'm going to split the screen again. So here we go. I think I'll split it right about there, maybe. Here we go. Let's go up here to the revenue on the adjusted. There we go. Revenue. Alrighty. So here's all we're going to do, folks, is we're going to look up repair revenue. So here it is right here. Revenue. $450. So let's put that $450 right there. There we go. And we've got expenses. Let's see here. Cost of goods sold is 100. Let's put it right here. And let's come down the list. And I'm taking all these numbers from this purpley colored column here. It's important that you don't look back on these other columns. Now, rent expense is 75. 75. There we go. And marketing expense is 45. And wages expense is 130. Let's put 130 in there. There we go. Parts expense 90. Let's drop it right down into here. And finally, depreciation expense. Depreciation expense is 25. Let's drop it into place. All right, so their total expenses. Let's add up those expenses. I should have it already added up. So it's 465. Now to figure out net income, what do? You take your revenue minus your expenses, and there's your net income. There we go. Okay, so it looks like after these adjustments, Fred is losing money. His business isn't doing as well as he may have thought. His net income is negative. He's having a net loss. And of course, Fred can't have net losses for too long or he'll be out of business. And that's quite different than that original income statement. The original income statement was right up here. Here we go. Here we are. Here's the original income statement. This was with no adjustments. With no adjustments, it showed a profit of $120,000, or I'm sorry, $120. And with the adjustments, which is more accurate, he's showing a loss of 15. Now, it isn't always the case that when you do adjusting entries that your income statement will look worse. Sometimes it'll look better. But the thing is the adjusting entries that we did will help the income statement be more accurate, so you'll have a better picture. And one thing that is really true in business is that you can't make good decisions with bad information. You got to have good information. So if you want to make good decisions, you got to have good information. And this negative $15, that's more accurate. It's a better picture of what's really going on. So hey, well, if you like this lesson, let me know if it helped you out. Hit the like button and subscribe, and that way YouTube will show this video to more folks. And also look at accountingsuperstars.com if you want to see where these videos are listed and topics and that kind of thing. It'll be a lot easier for you. So until next time, over and out.